ETFs are often used to add both passivity and instant diversification to portfolio holdings, and by selecting a handful of both fixed income and equity ETFs, most investors can pretty much call it a day. But is there a way to take it a step further for that passivity and ease of investing? Let's find out. Hey, what's going on, savers and investors? I hope you're having a great weekend as always. If you're new to the channel, then welcome. My name's Griffin, and in today's video, we are finally going to be speaking about all-in-one portfolio ETFs, which to my surprise actually gets requested quite often on both the channel and on Instagram. Most specifically, the VGRO fund, which is a Vanguard fund that focuses specifically on equity positions over fixed income. These all-in-one portfolio ETFs have really only been around for a couple years now, at least in Canada, and most of the large asset management companies have created their own versions of these all-in-one portfolio funds for the average retail investor based on a variety of different risk profile. For example, Vanguard has their own 5 different portfolio ETFs, as well as iShares has 5, BMO has 6, and then Horizons have 3 of what they call one-ticket index fund solutions. This to me is really a testament to where the Canadian retail investment market is heading in 2020, with more investors than ever looking to steer away from those traditional mutual funds and traditional asset management companies, and it really also showcases that the average retail investor in Canada recognizes how an ETF can be a really powerful vehicle for diversification of portfolio holdings and long-term growth. Now, obviously, it would be far too time-consuming to cover each one of these portfolio ETFs in detail in this one single video, so we're going to be focusing specifically on VGRO, which is Vanguard's growth ETF portfolio. But if you are interested in learning more about each one of these different portfolios by the different asset management companies, I'll be leaving a link down in the description to my blog where we're going to be covering each one of these portfolios. So on this channel, it's interesting because we've actually already covered a couple videos where we've gone over different portfolio constructions using only ETFs, which is basically the same thing as these all-in-one ETF portfolios. And these videos I had made were based on your risk tolerance and investor profile. The reason why I've spoken about the use of ETFs so extensively on my channel already is because for beginner investors, in my opinion, using ETFs is one of the best ways to create a foundational layer for your portfolio with what I call core ETFs. So these are ETFs that are going to expose you to broad market indexes and a variety of different positions, oftentimes in the 100 or even thousands of different positions, rather than starting off your portfolio with only 1 or 2 stocks, which is something that I see a lot of new investors tend to do. They'll go ahead and put all their money in 1 or 2 different stocks, which can prove to be extremely volatile and not necessarily risk averse. I personally hold a variety of different ETFs myself, specifically VFV, VAB, HXQ, and XIT, to really get a foundational layer of broad exposure in my portfolio. And then I also hold around 20 different individual stocks. So in my opinion, ETFs really have their place in most investors' portfolios, especially if you're watching this channel. You should probably hold a couple ETFs yourself. And it's now really interesting that there are these all-in-one portfolio ETFs where in theory you could buy and hold this one single ETF as your entire portfolio. So with that said, let's get right into the full walkthrough and characteristics of the VGRO portfolio ETF. And by the way, if you're still looking to open your first brokerage account, then make sure to check out the links down in the description where you can get some free money and free trades with the opening of your new portfolio. All right, so here we are on the Vanguard website, specifically on the VGRO page, which once again is the growth ETF portfolio, an all-in-one portfolio offered by Vanguard. And just a couple quick stats about this ETF right here, starting off with the NAV price. So the last price as of yesterday's close, which was April 30th. I'm filming this today on a Saturday, but the last close was at $24.79, which was down 1.33% yesterday. Pretty much all the markets were actually down yesterday, so nothing really out of the ordinary here. The assets under management are $1.1 billion, which for a fund like VGRO is actually relatively large. I remember looking at this a couple years back, and at that point, I think it was at 350 million in assets under management. That's the acronym here for AUM. And typically for an ETF that you'd be investing in like this, especially for an all-in-one ETF where you might be just buying this one single position, it's generally going to be more advantageous for it to be a larger fund, because what can happen with a smaller fund, let's say in the 50 million, 100 million range, well, the spread between the bid to ask over a long period of time can typically be relatively large. So with this, you could be losing out on some returns due to that large spread of the bid to ask. Now, the management fee for VGRO, to my surprise, is actually relatively low for what this fund is, at 0.25% MER. So that's the management expense ratio. And when you're looking at ETFs, you always want to look at the management expense ratio over the management fee, because the expense ratio takes into account the fee and then a couple other points related to other elements for managing this fund. So management expense ratio is what you want to be looking at. And at a 0.25% management expense ratio, this is a little bit higher than some of the other broad market index funds, especially offered by Vanguard. For example, VFV, I think, is at 0.08%. However, for this type of ETF where they're going to be purchasing underlying ETFs for you in order to construct a proper asset allocation, this portfolio, for example, is 80% equities and 20% fixed income. This added level of a service that they're providing you, in my opinion, at 0.25%, that is still relatively in a good ballpark range. In comparison to this, an actively managed mutual fund will oftentimes run you up 2% to even 3%. Think of that, 2%. This here is 0.25%. And mutual funds, as you're most likely aware of, these are funds that are trying to actively beat the market. They have active portfolio managers that are buying and selling assets for you. And usually this won't even pan out the way that it's supposed to, right? So a passively managed fund such as this, in my opinion, that's an okay management expense ratio. Now, by the way, if you're noticing anything different on my desk right now, I just purchased a brand new microphone. In 2020, I also went ahead and purchased a brand new camera. So I thought, you know what, I'll buy a new microphone as well to get just that much more sound quality for the viewers. I had a couple people basically comment that, especially for screen overlays such as what we're doing right now, the sound quality really wasn't up to par. So here we are with a brand new microphone. If you enjoy this, make sure to smash the like button. It really helps the channel grow. All right, so with those initial characteristics of the fund out of the way, let's move down a bit down to the objective. So this is a Vanguard growth ETF portfolio which seeks to track the long-term capital growth by investing in equity and fixed income securities. As we just mentioned, this is an all-in-one fund that will be basically allocating certain positions for fixed income and equity for you. Now, if you're interested in reading this stuff, you can go ahead and pause the video. Other fund facts, we have the inception date as the 25th of January 2018. So this is really a relatively new fund, only about 2 years old, 2 and a bit years old. And typically I don't try to invest in brand new funds because with this, we can't see the history of returns and how well this fund was actually managed. However, keep in mind, Vanguard, typically they have some of the best ETFs in Canada. Case in point, however, with the historical returns of this portfolio, the risk and volatility section doesn't currently have any information because this only will appear after 3 years of the inception date. With that said, this has a dividend schedule on a quarterly basis, and the last income distribution per unit as of the last distribution was 9.4 cents, which for a fund such as this is actually relatively high in my opinion. This translates into a dividend yield of right around 2.5%. If we compare this to the dividend yield of another fund such as, for example, VFV, that has a distribution, I'm pretty sure, of 1.7% if I'm correct. So for an actual fund here that isn't specifically focused on dividend distributions, 2.5% is actually quite nice. Let's now take a look at the portfolio data section of the VGRO page. So once again, the stocks are at 79.56%. So this is a fund that is focusing or trying to focus 80% of the portfolio holdings into stocks or equity positions, and then 20% in fixed income. So in this particular case right now, the way it's structured is 79.56% stocks and 20.34% as fixed income in bonds. Now, how does this actually break down? Well, right now, the amount of stocks held within this fund are 12,525 individual stocks. That is just insane. And honestly, this is not hand selected by the portfolio managers for this fund. The reason why there are so many stocks within this fund is because there are underlying Vanguard funds that comprise or make up this VGRO fund. So in this particular case, we have 32.4% that is focused towards the Vanguard US Total Market Index ETF, and then 23.80% as the Canada All Cap Index ETF. So these are two ETFs that are basically going to give you broad exposure to the American and the Canadian market, and it's really for this reason that there are so many stocks held within the fund. Other equity positions are the Developed All Cap X North America Index. So this is basically a fund that is comprised of stocks that are located in developed countries, such as, for example, Europe or other developed countries, maybe Australia, and it excludes everything that has to do with North America, so Canadian and American positions. Finally, for the equity positions, we have the Vanguard FTSE Emerging Markets All Cap Index ETF, which represents 6%. So this is going to be a fund that invests in emerging markets. This, for example, could be comprised of certain Asian emerging markets and etc. Now, in terms of the fixed income positions, once again, this has 16,401 individual bonds held within this VGRO portfolio ETF. This is obviously not hand selected. Once again, we have underlying Vanguard funds making up all these individual positions. So in the VGRO fund, we have 3 funds focused specifically on fixed income, which are the Canadian Aggregate Bond Index, which is VAB at 12%, the Global ex-US Aggregate Bond Index ETF at 4.4%, and the Aggregate Bond Index ETF Canadian Hedged at 4%. Notice that this makes up relatively 20%, and then these 4 positions right here make up 80% of the fund. And another thing I'd like to bring your attention to is the fact that for the fixed income positions, everything that is outside of Canada, so these 2 right here, is hedged to the Canadian dollar. One more thing to mention regarding the fixed income positions before moving on is that the bond indexes themselves are more heavily weighted towards government and treasury bonds over corporate bonds for the ETFs held within VGRO, which government bonds tend to be of higher quality and less risky, but with this, the yield is somewhat lower in accordance. But I personally tend to prefer these bonds over corporate bonds anyways, because they have better credit ratings and are less volatile than corporate bonds. Quickly going through some of the other characteristics of this fund, let's take a look at the market capitalization. So this basically right here is going to be the average market cap of the underlying stocks held within those other ETFs. So in this case, the stocks that are held within this fund are 80% roughly in the large cap category. So a large cap stock is typically going to be a company that has a market capitalization of above $10 billion. With this, usually there is a higher level of stability. Oftentimes, they're also going to be paying a dividend payment, but the trade-off is that there is going to be less potential for extremely rapid growth of your portfolio. This doesn't mean that there won't be rapid growth. However, typically a large cap company will provide less potential for rapid capital appreciation over, say, a medium or small cap company. A medium cap company, for example, is usually going to be in the $5 billion market cap range. So as we can see here, the large portion is in large cap companies. Moving on to the market allocation, this is actually in terms of the region. So based on those underlying other ETFs, we can see that the United States has 40% of this fund. So 40% of the actual stocks in this fund are located in the United States and 30% in Canada. So from all the actual equity positions, we have roughly 70% that are located in North America, and then 40 other countries here. If we take a look, there's 50 different markets and 2 of them are in North America. So there's 48 other companies that represent that other 70% of the equity positions. The same is relatively true for the fixed income. So in this particular case, we have just under 80% of the total fixed income position being located in Canada and the United States, and then about 64 other markets where there are fixed income positions represent about 20% of those fixed income positions. In terms of the weighted exposure, so this is basically of all those equity positions, where are these companies located in terms of an industry? So we have, financials, technology, industrials, etc. And in this particular fund, 24.3% currently of the equity positions are located in the financials. This is not necessarily all that surprising, considering that in Canada, the financial companies such as the large banks and then some of the other asset management companies do represent some of the largest capitalization companies. And as we just looked at, about 80% of all those equity positions are large cap companies. So this is really not all that surprising. And also the financial sector tends to give out a nice healthy dividend. Moving on to the distribution per credit quality, as I mentioned earlier, most of the fixed income positions were either treasury or government related bonds. So for this reason, they're going to be high quality with AAA or AA positions. And this really just brings a lower level of volatility to the portfolio. So considering the fact that this is an 80% equity fund and 20% fixed income, typically this is going to be a higher level risk fund. However, it is still rated a low to medium risk fund due to the fact that most of the equity positions are large cap companies, and there's such diversification in this fund, roughly 15,000 equity positions. This provides your portfolio with massive amounts of diversification and exposure to equity positions in various markets, bringing down the overall risk of the portfolio. In correlation with this weighted exposure being heavily weighted in the financial and technology sectors, if we actually look at the holding details, we can see that the largest holding is Royal Bank of Canada at 1.67% of the total fund for a market value of around $19 billion. Following Royal Bank of Canada is Microsoft Corp, which is an extremely solid company, great balance sheet. We've actually already looked at Microsoft Corp in one of my recent videos doing an intrinsic value calculation, but Microsoft is a really solid company. TD Bank, same thing. Apple, basically all of these companies as the top holdings are really solid companies that have great potential for future growth as well as stability. Now, from a taxation point of view, just based on the nature of the holdings within this fund, you are going to be subject to foreign withholding taxes on the dividends earned from this portfolio due to the fact that, for example, we have quite a few positions that are in the United States as well as international markets. With that said, if you haven't already watched my foreign withholding tax video, make sure to check it out. I'll leave a link right here or here in a card, but I personally would not be all that worried. Foreign withholding taxes is going to represent 15% of your dividend income if held within either a taxable account or your TFSA. You can basically avoid foreign withholding taxes if you hold these positions in an RRSP, but in the big picture, 15% of only the dividends is not, in my opinion, that big of a deal. Let's now speak about some of the advantages and disadvantages of holding an all-in-one portfolio ETF such as VGRO. Starting with the advantages of holding these one decision funds such as VGRO, the largest advantage really is going to be the simplicity over everything. So this takes ETF investing really to another level of passivity, where basically you can just purchase this one single holding and they will do everything for you. So by paying a little bit more in management expense ratios versus adding, for example, VFV, VAB, and some other individual ETFs, your exposure is going to be much broader, and then paying this added fee for a higher level of management is, in my opinion, actually justified. With this added level of simplicity, you will also benefit from automatic rebalancing of the portfolio for you. So the asset managers at Vanguard that take care of VGRO are going to be buying and selling different ETFs in order to rebalance the portfolio based on what's going on in the markets. Relative to a mutual fund that also rebalances the portfolio for you, the management fee of 0.25% is extremely minimal versus an equity mutual fund. You're looking typically at 2 to 3%. So with the ETF, you're looking at significantly lower management expense ratios than with a traditional mutual fund. The all-in-one ETF portfolio is also designed to fit the different spectrums of investor risk appetites, and you can easily switch between the funds if your financial situation changes. Remember that Vanguard, for example, offers 5 different options. And finally, for the advantages, remember that these all-in-one portfolio ETFs are just that. They are an ETF themselves, so you can easily buy and sell them on an exchange just like you would any other ETF or a common stock. Now for the main disadvantages of VGRO or any other type of all-in-one asset allocation portfolio, the main disadvantage is really that you can't decide on any rebalancing yourself or adding any new positions. So although this actually is kind of an advantage for some individuals, it can also somewhat be a disadvantage. But as I mentioned, there's no reason that you wouldn't be able to go ahead and purchase this ETF as a baseline for your portfolio and then purchase other positions on the side as you see fit for your own portfolio. In addition to this, even though we just mentioned that the 0.25% management expense ratio is, in my opinion, justified for what you're getting with this fund, it is somewhat higher than some of the other broad market ETFs such as VFV, VAB, etc., which have an MER in the 0.0% range. So if you're someone who does want to be a little bit more hands-on, you could lower this management expense ratio by actually purchasing the underlying ETFs themselves. Now, full disclosure, I personally do not own any shares of VGRO or any other all-in-one portfolio ETF for that matter, just based on the fact that I like to be a bit more hands-on with my selection of individual ETFs or individual stocks. But that's not to say that this is not a good option for someone who's really looking for that added level of passivity. As we spoke about at the beginning of the video, at a 0.25% management expense ratio, you really can't go wrong with this, and it comes with the advantages of having that rebalancing for you, and this is really an all-in-one portfolio position. This is the type of fund that if you're new to investing or you really just want full passivity, basically just invest and forget, this could be the ticket to that. Or you could also use it to create a foundational layer in your portfolio, and then from there, after that, go ahead and select some individual stocks or other ETFs. Basically, you can use this to create your own portfolio construction and essentially meet your own needs as an investor. So with everything that we just mentioned in today's video, what are your thoughts on these all-in-one portfolio ETFs, or more specifically the VGRO ETF? Make sure to leave a comment down below so that we can start up a conversation. If you enjoyed the video, then make sure to smash the like button, and if you want to learn more about investing in the stock market, then make sure to check out one of the 2 videos right here. So on that note, thanks a lot for watching, and I'll see you in the next video.